volatility is to be expected, but the chart is all telling. So I don't need FOMC to tell me where the price is going to go. The chart is saying this is the new ceiling, the new floor. 2 minutes left. So we have this old breaker, which can be now used as support. All right. Which also has a confluence of being a this FVG. So we're assuming that this intermediate term low at 135 is the new floor until we take out this 1030 high. And then from there, I'm expecting a turtle soup reversal into new lows, into the December liquidity pool. So let's see what happens. Now you don't want to see them breaking below this this low, otherwise that's going to be the first sign of bearishness, or it's either a sign of bearishness or a sign of consolidation. Either way, you don't want to be part of it. So let's demo enter here. Stop loss is over there, visibly. All right. Let the games begin. 15-minute chart. Disrespecting this 15-minute fair value gap at 12. So this is going to be the new, we're going to flip this into support. All right. A 30-minute chart. All right. Let's stay on the 3 minutes. There you go, lagging exactly at FOMC. What a coincidence. Fake market structure shift, as you can see. There you go, beautiful, gorgeous. All right, folks. So we have here a review of ES market maker model, right? Let me just go and slap on the tweet. So this is going to be brief. I intend this to be a brief, short, concise video, right? That for later. So we have this range going on, range low, range high, and we mark the opening time and the closing time of Friday. So it's Friday, and Friday is usually a choppy day, generally speaking. Why? Because of the open, high, low, and close of the weekly candle, right? So when you see price ranging, right, you simply play the range. So you see this previous day's high, right, which is a key level. So previous weekly highs, previous daily highs, previous monthly highs. These are all key levels at which you expect a reaction, right? Either to retrace or to reverse completely, right? So now, although they can be broken through from the first time, but usually the first touch of a previous day high, previous week high, these are key levels which garner a lot of liquidity above and below them, which is why they will usually, more often than not, and don't believe me, go verify for yourself, they will usually give you a reaction, some trade opportunity, either to retrace or to reverse. In this case, I anticipated them to give me a retracement, at least into the original consolidation of this market maker model, which is a pattern only due to the fact that it climbed up into this higher time frame PD array, right? So it climbed up into the previous day's high and hit the previous day's high at 9:30, right? So 9:20 onwards, I look for a turtle soup. Around 9:30 exactly, we had this, we had ES hitting a previous day's high and NASDAQ forming SMT at the same time. Right, so that is exactly why at that second I had called for a smart money reversal, aka turtle soup. At the previous day's high. So we rally in the shape of a market maker model into a higher time frame PD array. Right, so over there. Sell and decline. So entry 1 would be the turtle soup. Entry 2, this order block, FVG. Entry 3, the breaker, right over here. And there you go. Quick, brief, concise review. All right, folks. So we had last Friday we had a low range Friday, right? So pretty much just chopping around, right? And then after this chop, we broke this low, right? And we rejected this high. So that tells me there's bearish intentions, right? Breaking highs, rejecting lows, or rejecting highs and breaking lows. So price was in a range, in a clear defined range, right here. Quick stop hunt to the range low. Right, so we went and we took out the range low, right? However, we did leave behind this rejection block, and rejection blocks are liquidity pools. You can use them to enter from as turtle soup, or a failure swing that'll be, or you can use them to target, which is what I did in this case, right? So range, clear defined range, right? And if you've been following along for a while, you'll have known by now that one of my favorite types of turtle soup is this double top and then a purge of the equal highs, which are also previous week's high, right? So I'm not taking these equal highs for the sake of being equal highs. I'm taking them because they are also the previous week's highs. Because if you go around taking every single equal high or equal low for the sake of being equal highs and equal lows, then you're pretty much a pattern trader. And that does not work. Every move has to have a logic behind it. It has to have an explanation, right? So, range low. Of course, if any of you have been paying attention, again, this pattern will be familiar to you, right? So we purge the previous week's high into a higher time frame PD array. Right? 15. So midnight open. We had accumulation over here, generating interest on both sides of the range. Accumulation, quick stop hunt. So we didn't purge these lows, right? We left behind this liquidity pool right here. And notice how the consequent encroachment, or the 50% of the gap, of the wick rather, is also a lower time frame liquidity pool, right? The same way, lower time frame rejection block is a higher time frame rejection block is a lower time frame order block, right? So everything is fractal and connected. A higher time frame breaker can be seen as a lower time frame turtle soup, and so on. That was the idea. The idea was this liquidity pool had not been traded to yet, left behind, right? That was where I had my eye on, especially that we are in a bearish profile, which means we're breaking lows right here and we're rejecting highs, which means any pop above a high is to be smacked down, right? Now add to that the way it climbed up, right? The shape, so opening price, opening time, stop hunt, accumulation over here, manipulation, accumulation over here, manipulation, distribution. That was a cycle within a cycle, so accumulation, manipulation, distribution, right? But within the daily cycle, meaning candle, of course, nothing too fancy. So within the first 4 hour candle, right, which is 1 to 5, right? You have the manipulation over here and the distribution. So we had a classic sell candle on the 4 hour profile. Now I didn't want to go into this, but now that I had that slip, I must explain. 1 hour open, right? So this is profiling 4 hour candles. 1 hour open, drop below the open into a previous liquidity pool, right? So a turtle soup, you see? And there's also a gap over here, a fair value gap, which is also a liquidity pool because fair value gaps are liquidity pools. They're highs and lows, right? Especially the upper part of a bullish fair value gap and the lower part of a bearish fair value gap. So opening price of the opening time and price of the 4 hour candle, right? And the closing time and price of the 4 hour candle. One, two, 5. So we had a classic sell candle on the 4 hour, which could have been traded in and of itself, right? So that was what I meant by the first manipulation. So, but on the daily candle, we had a accumulation down here. Accumulation. Three-minute, more clear. Accumulation down here, right? Leaving behind this liquidity pool down here, right? So the original consolidation of a market maker sell model of a reaccumulation. And then smart money reversal at a higher time frame PD array. I don't use these market maker models for the sake of because they look like one. No, it has to be in the correct context. All right. So smart money reversal, and then SMT. And when I saw this SMT, that's when I said, you know what, this 30-minute order block can be used. The high as a stop loss. Why? Because it's a high that took out liquidity, right? The highs that take out liquidity can be considered a safe stop loss, because if you're right, then the turtle soup top has a lot of liquidity trapped above it. So it's not supposed to go back up there, right? If it goes back up there, you're wrong. But if you're right and you review the trades you took and the journal, if you journal, because you should, that if you review what happened, you'll notice that the highs and lows, the turtle soup tops and bottoms, they're usually never retrade it to until a liquidity pool is taken out or a balance is rebalanced, which is also a liquidity pool. I just said balance and I meant imbalance, but that's fine. So we can just act like nothing happened. So the stop loss is going to be above this order block's high. All right. When I saw this SMT rallying after the midnight open, accumulation, manipulation into a higher time frame PD array at the end of London, which is 3 to 5, the good old 3 to 5 time window, right? So opening price, opening time right here. We open. And I want to make this as simple as possible, right? Because that's how it should be. So remove this, remove all this. In summary, and I have spoken about a lot more than I intended to, right? Which is why it's probably a bit longer than normal. So that's okay. So in summary, in what? In summary, with an S. Opening price, opening time, accumulation, manipulation, distribution. Accumulation, climbing in the shape of a market maker model, stopping at a higher time frame PD array with an SMT, and that birthed the trade idea, which was over there today. All right, stop loss was, it looks cool, of course, the way I put it, but the way I design it, the way I want it to look, but it's simply an OB, simply the high of an order block, which also took out liquidity. So a turtle soup top. And yeah, that was it, nothing too fancy. Just a good old accumulation, manipulation, and distribution, and good luck, and happy gambling. So we had a Euro USD, had taken out this liquidity pool, right? And we had left the higher liquidity pool untapped, right? So, and during this leg up, we've been breaking highs, right? Rejecting lows right here, and breaking highs, and respecting bullish PD arrays, right? So, breaking highs, rejecting lows, respecting bullish arrays, right? So what that means is that we were expecting higher prices on Euro, right? So we draw this rejection block. So we broke this high, right? We broke this high, and we're expecting any dip with P below the low to be a false move. Why? Because in a bullish market, bearish dumps below lows are to be bought, right? And in a bearish market, bullish pops above highs are to be smacked back down, right? The opposite over here. So bearish market, so a downtrend, bearish order flow, whatever you want to call it. You got this. Highs rejected, lows broken, right? Lows broken, highs rejected, right? And over here we have the opposite. We have highs being broken and lows being rejected. After a long, just 1 month, 1 month of a downtrend, or 1 month of a bearish order flow, we finally have started to break highs instead of rejecting them, right? So reject, break, right? So bullish order flow, in short, right? So we mark out this rejection block right here. And if we come below it, right? If we don't close below it, because if we close below it, it's going to be a breaker, right? Bearish candle to cause the purge, right? So it's a rejection block until it's closed below. Then it becomes a breaker. But because we're in a bullish market with bullish order flow, we're expecting the declines or dumps below lows to be for buying, right? Especially that we took out this range low liquidity pool, the body, and we hadn't yet taken out the range high liquidity pool of the body, right? So I had this target in mind, at least the range high of the body, right? Potentially this, but this one first, right? So what's been happening so far? We've been rallying, breaking highs, rejecting lows, right? Breaking highs, and then falling down beneath a low, which means we're expecting it to be a fake move below the low to keep rallying, right? So we mark the opening time and closing time. The same old boring procedure, right? Nothing new. Closing time. So we had this, we came short of the key level. You remember the last video where I spoke exactly about this phenomenon, right? Where you violently come and approach a key level, but not yet touch it, not quite contact the level, right? So violent rally, coming short of a key level, right? Making everyone think that the bottom is in, the top is in, rather, right? So rally, rally, rally. Didn't touch the key level, which is a liquidity pool, right? And then decline. Lowering the participants of the market into thinking that maybe the rally is over, right? Now, why was this a target? Why this rejection block? Because those who were short down here, up here rather, where's their stop loss going to be? The stop loss is going to be above this body. How do I know? Because when I would trade before ICT, right, the retail logic and theory tells you to put your stop loss above the bodies when there's a large wick. Now look at the indoctrination that's happening. So in retail logic, if there's a large wick, you literally put your stop loss at the body of the wick, right? And that's what a rejection block is. So retail logic told you, let's clean this up. Retail logic told you to put the stop loss right over here at this body. And what happened? We reversed from the place they are taught to put their stop loss. So same logic. The stop loss was this rejection block, and if you would like to be fascinated by price, then go and study rejection blocks, right? They're a good PD array to use to anticipate a turtle soup from. So anyway, opening time. So all this was was in the intro, huh? Now we come to the trade itself. Opening time, closing time. Higher time frame PD array, daily rejection block to the downside, and a target because we're bullish, right? We've been bullish all this while, breaking highs, rejecting lows, right? Breaking highs, rejecting lows, up close candles being broken, right? And down close candles supporting price to go higher. Right? That is the definition of bullish order flow, right? So we have the two PD arrays, which are limiting price, so to speak. We have one here as the target, and we have one here as a potential low of week area. Now, I did expect it. I expected it to go a bit lower, right? Possibly turtle soup this low. But when I saw this rejection off of the daily rejection block and the 4-hour FVG down there, right? 4-hour FVG right here. You blend this with an OTE, right? And you get exactly what happened. So, remove. We declined violently after the weekly open. Right, weekly open, short. I got this sell over here, the one we reviewed in the last video, right over here. So as we've mentioned, as I have mentioned, the weekly candle or any candlestick, we focus more on the weekly and daily and 4-hour, which are the kill zones. Why? Because they simply they offer a good enough range to be tradable. So you don't want to be open, high, low, and closing 5-minute candles with 1 second charts, right? You can do that, but it's not ideal. So each candle has 3 trades: the open, what is this? The open, the low, and the high. These are 2 guaranteed trades, right? Which is the low and the high, or the high and the low of a bearish candle. Because price is going to reverse. It's going to go open, high, low, and close, right? In the 6 different ways, which I've mentioned on Twitter. I will retweet that tweet after this video. So each candle has 2 guaranteed trades: a reversal at the bottom and a reversal at the top, right? And of course, an OTE in the middle. That's read number 3, right? So opening time, and then we decline. We decline violently, and the more violently you decline into a key level, the more likely it is to hold, right? In my experience. So you can go and study that. So when I see a key level being hit slowly and drifting towards it slowly, then I don't like it. When I see a key level being hit at the correct time violently, then that is what I like to see personally. So we decline, open, low, and then we rally, right? Now, because the overall market is bullish on the daily, we're respecting daily bullish PD arrays, right? So this can be a turtle soup, the weekly low, 1 shot, 1 kill, a turtle soup at the weekly low, which happened at the daily rejection block, right? Now, and it declined over here. Look at the fractal nature of price. So the same way we reviewed this trade, right? The trade before this video, this was the trade that I reviewed and took last week, right? So the same way this climbed up in a market maker model formation, right, on a lower time frame into a higher time frame PD array, the same way this happened on the 5-minute, the same thing is happening on the 1 hour. So we're declining into a higher time frame PD array in the shape, let's move this noise. So we're declining into a higher time frame PD array in the shape of a market maker buy model, right? So the shape alone doesn't matter. So I've combined multiple things. I've combined the daily order flow, bullish, yep. Combine that with a rejection block, with an OTE, with a 4-hour fair value gap, with a decline from the opening price, right? So you blend that together, and you can narrow down the chances of price, of the directions price can go. So if price declines in the shape of a market maker buy model. Now, a disclaimer, I was expecting it to go a bit lower, as I mentioned in the video, but when I saw this reaction off of the rejection block, then you can pretty much forget it, right? There's no way it's gonna go above this. There's no way it's gonna go and create for you this 4-hour fair value gap, right? Trading through this candle, which is a breaker, correct? So we have a low, a high, a lower low, and a higher high. As soon as we close through the breaker, right, it's confirmed as a PD array to be trusted, and the stop loss below the intermediate term low, right here, and target is the original consolidation, which is also the daily rejection block on the premium end of things, right? So that was the idea. That was the idea I had about this specific trade, and this is what I had in mind when I posted this trade right around here, right? So before it rallied, I recognized what was happening, which is buy model declining from the weekly open, price and time declining into a higher time frame PD array, and then rallying, right? And then respecting a bullish PD array on the 2-hour and the 4-hour, right? So when I see that happening, when I saw that happening, rather, and I posted right over here, I did miss so I caught this move down here, right? I missed this move up here, and I caught this move from here to here. You see? So you don't need to, and later on, of course, I caught this turtle soup up here, which will be reviewed later on as well. It was very clean, or if you want, you can go and look into it yourself. It's very clean, obvious turtle soup setup to cap the daily range, the weekly range, right? So trade number 1 is down here, and trade number 2 is this one to cap the weekly range. So that was the thought process I had during when I posted the idea of euro attacking those relatively equal highs. Look when I'm considering them. Again, I don't mention relatively equal highs just for the sake of being relatively equal highs, right? It has to be within the context, within everything. All those confluences are stacking up and adding up, leading to this idea. Now, maybe it sounds complex at the beginning, but it's just it's second nature. So it looks like a lot of stuff. It looks like a rejection block, FVG, OTE, price, time, all this mixed together, but it's pretty simple. It's a very straightforward procedure. The main idea is the higher time frame PD array, right? So the main takeaway is the higher time frame PD array over here, and the decline from the opening price, getting everyone bearish down here, and then rallying, right? The shape in which it declines is a convenience buy model, right? So the main focus was the opening time and price, right over here. Of course, opening time, opening price being used as support later on. No surprise there, right? So the main two components were the decline from the opening price and time into a higher time frame key level, right? So that's all for now. Again, these videos always get longer than I anticipate them to be, but it is what it is. So I hope you found that insightful, and good luck and good trading, and until the next one. then it's reasonable to expect that the high of the day, at least until New York is in. All right, so that's why I sold right here. Good morning, folks. I'm not sure exactly what time it is in your local area, but I'm in Spain right now. And in Spain, it's a good morning right now. So good morning, folks. And I just woke up like, I don't know, 10 minutes ago. So I might let some things slip, which I wouldn't otherwise. So good for you. Anyway, at the end of the vote, ES won. All right. So although I must admit Euro was a lot more interesting, we're going to have to go with ES. The people have spoken. And their word is going to be allowed this time. Because usually it's a dictatorship. There's no democracy in the group. Excuse me. Anyway, so we start now. Now, as we have been taught, the best way to analyze a chart is not to open the chart and go to the 5 minute, 1 minute, and just look for a market structure shift. Because that's what they do on Twitter, but that's not the ideal way of doing it. All right? The ideal way is as follows. So you open a chart, you want to enter a trade. For the most, for the highest probability trade to form, you must go through this process, which is number one, you see the seasonality. Number two, you check the monthly bias. Before I continue, I know some of you personally who are in here who are not that proficient, and in that case, go study and come back and listen later, because I'm assuming that the vast majority of you who are listening are at least semi-proficient with the concepts. So when I speak, it's not going to be like I'm speaking to you in gibberish or some other language. Okay? So, back to the sequence, which is first, the seasonality. Number two is going to be the monthly bias. Number three, the weekly profile. Number four, the daily bias. Number five, the time of day within the daily bias. So now we have that aside. Now we apply this on ES, which won your vote. I know some of you are disappointed in the result, but it is what it is. Maybe I'll review the EU later if I get enough requests. So we look at ES. What do you see? Now, the fun thing is we're going to ignore all these candles. Most of these candles, they don't matter to us. We're looking at a 20, 40, and 60-day look back. Okay? So that's going to be around 8 weekly candles. So we go 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. All right? And then within that time period, we mark out the PD arrays. Now, before I mark the PD arrays, there's something more important than the PD arrays, which is liquidity. In this instance, we have had a purge in liquidity, right here. You see this? So smart money accumulated their shorts up here, and now they're violently taking it back down and distributing it in the opposing direction, because that's what they do. So we have had a purge, and we are now in a cycle of purge and revert. All right? You got the purge, you got the failure swing, and then you got the continuation lower. Now, the end goal of this purge and revert cycle we're in right now is this original consolidation, in my eyes. So for me, the bias for ES is down until we take this out. So that for me has it gets the magnet emoji, or the eye emoji. Get this color, a little bit more precise. And then we go and give it the eye. Eye. So we have had a purge on liquidity, where smart money has accumulated their shorts up here, clearly, because some people went long up there. We saw them on Twitter. We saw my harmonic friend, which I sent as a warning at the top. It's always see, there's a lot more losing traders than winning traders. So it's there's always some indicator at tops and bottoms, which I like to take guidance from, take a signal from. So all that aside, we have had a purge on liquidity, and now they are distributing that liquidity to the downside. Because for every buyer, there has to be a seller, and vice versa. It's not just price randomly moving around. So we go back to the weekly chart. We have had a purge on liquidity, with the draw on liquidity being number one, the rejection block, which has been reached. All right. And it gave us a reaction. So one target has been met of this purge. All right. Which is the body of the candle. The next target is the wick of the original consolidation. And as we know, at each target, we expect a reaction, potentially a reversal if we have SMT. So keep that in mind. But again, the distribution and accumulation is done between highs and lows. So they take orders from highs and lows, and they distribute them to highs and lows. So after the purge, we were given a PD array, which is this order block. As soon as this candle closed below it, we have as one order block right here. All right. And then that order block gave us another order block, which is a propulsion block right here. All right. So we have time, which is the data ranges. We have a liquidity purge. We are in a distribution cycle right now. And we have these two PD arrays to key off of. I think that's clear enough. Sadly, you cannot communicate to me your questions in this one because it's recorded, but maybe in the live stream next time. So, and that's also a breaker, by the way, right there. So we have two PD arrays overlapping. So we remove this noise because I don't like my charts to be dirty. And we go down to the weekly profile. We mark the opening of the week at Sunday, and we mark the closing price, or the closing time rather, of the week, which is Friday. All right. Now, this specific trade was taken at the end of the week on a Friday. So we're going to ignore all of this for the moment, and we're going to focus on the end of the week, which is Friday. So we mark the midnight price of Friday. And this is the section of the week. We're going to ignore all of this. We're going to consider it to be noise, except this high right here. And we're going to focus in on this subsection of time we have here. All right. And yeah, that's it. There's no and. Now, the best chart in my eyes to look at the weekly profile is the best time frame is the 2-hour time frame. All right. And the best time frame to look at the daily profile is the 15-minute chart. You can also use the 5-minute, but I prefer the 15 because anything below the 15 is noise. So my preferred time frame of for looking at a weekly profile is going to be the 15 always. And I just said weekly, and I'm in daily, but we're just going to act like nothing happened. So this is Friday. Of course, none of this had happened. All right. So we're going to look at it and imagine that this is all invisible. We only I just now noticed that they offer the volume of the candles within this movement, which is cool. Anyway, that's off topic. We're going to ignore that any of this happened. All right. And we're going to focus on the opening time and the closing time of the candle. So before we go into this day, we look at the previous day's high time frame PD arrays. We have this BISI or discount fair value gap right here. All right. So that's one area to look at as a target. And we have the previous day's high. Over here, which is still pending. So go to the 15-minute chart. Now, whenever we see the previous day being extended already, all right, you got to focus on this one. So we are now on Thursday and Friday, which we know cap the weekly range. So it's unreasonable to expect a continuation of the range, except if we did not reach the average weekly range, which we did, I believe. But it's not reasonable to expect an extension of the range. It's more reasonable to expect a reversal, at least to mark the weekly high. Because as we know, Monday, Tuesday, Wednesday will mark the low of the week, and Thursday, Friday will usually mark the opposing end of the range of the week. All right? Weekly profiles, month 7, if I'm not mistaken. If it's wrong, I'm not gonna edit or delete, because who cares? But it's month 7, that's for sure. So we have the previous day's high right here. All right, we draw the kill zones, the so-called ICT kill zones. We go from 1 to 5. That's London kill zone. We go from 8:15 to 12. That's the New York kill zone. And we go from 1 to 4. That is the PM session in the classic colors I use on my Twitter all the time. So we have the opening time. All right. And it's a Friday. So you focus on what time is it? Time, which is time of day, day of week, week of month, month of year. So now we are at the end of the week, which is Friday. We're expecting the opposing range of the week to form and give us a reversal. All right. That's a reasonable expectation. So, and the previous day was already extended to the upside. So when we see this and we see a rally from the opening price into a higher time frame PD array, which is for you to find and me to know. So we rally after the opening price. During London and at the end of London session, we get a bearish order block. All right. Now, as soon as you get a bearish order block on a 15-minute time frame at the end of London session, then it's reasonable to expect that the high of the day, at least until New York is in. All right. So that's why I sold right here. I'm gonna post the receipts because that's what people like after this recording in the group chat. But I'll resend it. So with the Friday review, but I'll send it again. I don't mind. So the point is, end of London, bearish order block at 4:30. So we expect the high of the day to be in. We decline rapidly. So anything above the opening price was premium. We decline rapidly, and then we witness the classic New York OTE, and this is the idea by which I sold. All right, so now we go down into the even lower time frames, which is the 3-minute time frame, the one I used. So it looks like a turtle soup. Oh, it's just a turtle. No, it was a classic sell day on a Friday, expecting the opposing range of the week to form. So reversal at the weekly range. All right. And then this is as you can see, we have expansion, consolidation, protraction, reversal, and then expansion again. That's the idea. So you have to look at everything that happened before New York. You have to mark the daily range and look at it holistically. So I forgot to mention that after this decline we had produced an hourly fair value gap right here. And a breaker. So we have the famous unicorn model. I don't like those names. I like to have a simplistic, basic, bare bones approach. None of that nonsense. Doesn't resonate with me. So, as we can see, we go to the 3-minute time frame. All right. The time is New York kill zone. And we have right here the breaker, which is the black line. And we have the gap, which is the gray line. Now, we know that breakers stop gaps from filling in, right? So when you see this, you assume the top is in. But then again, you go back to the rule of the 3 different types of reactions at a key level, and it is safe to assume that you will expect a second touch of the breaker, because that's the most common reaction. So now finally we go to the 1 minute after already seeing focus and see when we use it. We see the 1 minute after already seeing the weekly, the daily, and the monthly. All right. And now after all that, then we go to the 1 minute. So it's not the main time frame. So this is the breaker reaction, pretty strong reaction. This is a fake market structure shift. This is it right here. A lot of people were suckered down there to sell. I saw a bunch of people too on Twitter. They were like, they sold over here, like right here. They sold at this rectangle, and they held it over here, and they held it over here. And then when it rallies down here, they're like, "Hey, oh, I gotta sell." That's bullshit. You have to hold a standard. You have to hold yourself to a standard. You can't just, you can't be happy with that performance. You can't be happy with entering here and then getting turtle souped, and then me entering here, and then when it finally, after you're sweating your sweat out, I'm not gonna swear. So you held this, you shorted here. You were sweating when it came back here. Oh, finally again, and then you sweated again when it came up here, and then finally, after two emotional roller coasters, finally you get the profits. Is that really what you want for yourself? And this is to the people who, this subsection of the video is to the people who are celebrating subpar performance. Is that really what you want to do? Is to go and sell and then watch it go up and then worry and then, or do you want to enter at the turtle soup itself, which is what I do all the time, every day, every week. So, fake market structure shift right here. Then this is the real Judas. This move happens a lot, which is a key level, maybe a touch, a slight touch, or maybe even not a touch. We have this fake market structure shift, a double top also. Back in my retail days, I would definitely be selling this short down here and getting wrecked, and then watching it come back down. Good old days. So, so finally we get the second touch of the key level, and we get a dig into the 1 hour fair value gap, right? And this is where I went short. Let's remove this noise. We focus only on the main PD arrays right now. The 1 hour fair value gap. So this is turtle soup right here. The turtles have been souped right there. Beautiful. My entry was based on the 3 minutes, of course, as you saw, the infamous, famous rather, not infamous. Infamous means bad. The drawing was based on this. So I had this 1 hour fair value gap pending to be purged. So when I saw this fake market structure shift, I knew someone had been suckered in. All right, someone accumulated longs over here, and they need to distribute the longs above this high into the gap. So that's when this idea came to mind. Right there. Looks good in hindsight, but it's all there in foresight. The proof is in the pudding. That was the idea. Now, some of you are going to ask, how don't you know it's going to keep going higher, blah, blah, blah. I just know, because I have Enigma. Well, not really, that's a joke. The reason I know it's not going to go higher, all jokes aside, is because of this intermediate term high. A lot of you watched that episode and were like, oh, this is too complicated. What is this? What is this complication that ICT, blah, blah, blah. It's to each his own, but I use intermediate term highs as stop losses and as a mechanism to probe whether price is bullish or bearish. So if an intermediate term high is being held, then we're bearish, and vice versa. All right. So this would have been a stop loss, by the way, a very valid stop loss. But I like to play it safe, especially when dealing with large amounts of capital. So my stop loss was the high of the fair value gap right here. All right. So that was the idea. That was exactly the idea. And it was actually a bit higher, by the way. So I was being super conservative. If I had given this out to someone else, I would also be conservative. But this is a valid stop loss. This is a valid stop loss. So that gives you what? Let's take out the infamous risk to reward position. So this would have been a 4 risk to reward. It could have also been easily an 8 risk to reward, and that would be super valid. But the safe play, which I did, was this. All right. But that's where the famous, that's where the idea came from. That's where this arrow was born from. And kept declining into 12 p.m. And then at 12 p.m. it marked the low of the day. This is like classic. This is an example of a classic sell day, like a super classic sell day. Beautiful, absolutely gorgeous. So opening price rallying above opening price, decline, expansion, consolidation, protraction, which is a New York OTE as well, into the 1 hour fair value gap, which is a higher time frame PD array, and then it expands lower. All right. So that was the idea. That was easy and quick and easier and simpler than the EU one. Maybe if EU, we'll see. Maybe this week, next weekend, we will review the EU trade which I took. Or if there's other trades that present themselves, we can also look at them every day, every week, well, every hour, every 4 hours, and it won't stop. And on that note, I wish you all good luck and good trading. And see ya. So that was the idea. Over here, stop loss here, target here. And a bunch of you liked it. You guys liked this trade, huh? And now we go to the trade itself. So that whole 5 minutes was pretty much a review on Euro and what's to come. But let's focus on the main part, which is the trade I took. So again, we look back to cast forward, right? So the previous 3 days highs and lows, and the previous 20-day high and low are a reference point at which liquidity accumulates, either above or below. We know that liquidity accumulates, liquidity pools, they form above highs and below lows, right? And liquidity is accumulated and distributed from above highs to below lows, and vice versa, right? So when thinking about price, you're going to think, where is liquidity being accumulated from, and where is it going to be distributed to? Good? I'm asking you questions like you can respond. It's a recording. I'm just used to the one-on-ones. So, we count back the previous 20 days. If you go through the core content, which I believe is the most complete course regarding the markets that there is and that there ever will be. So, after that course, the 2016 mentorship, there is nothing else that can top it. So that's giving props to the mentor as he has earned. So in the core content, in the day trading routine, if I'm not mistaken, it's month 9. It's been a long while. So in month 9, in the day trading routine, what does he do? And of course, if it's the wrong month, then don't hold it against me. But I think it's month 9. Anyway, he mentions that from the first steps of opening a day trade is, if you want to be, of course, planned and organized, is checking the calendar for scalpers, because price affects news affects price fluctuations and speed, not the direction. That's already predetermined, right? But the speed at which it goes is delivered through news drivers. So, in that specific episode, and this is something for you to backtest by yourself, you're going to count back to the previous 20 days range. And relative to the previous 20 days range, are we in a premium or are we in a discount? So, we were here at the time. Here, rather. So you go 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, and 20. So, at the 20th day, we have these equal highs right here. And before you say to yourself that those are not equal highs, yes, they are. Check this out. If you remove the wicks, look how clean those bodies are. So levels like that, usually they are attacked more often than not. This is not just me parroting ICT. This is actual my observations and experience with what he's saying. So if you don't believe it, go back and check for yourself. Right? So we are at a premium relative to the 20-day high, which is this. We're going to give it a bold black line. All right? This is the 20-day high, which also is a high, low, higher high, and lower low. So order flow, quote unquote, is bearish. We're trending down at the moment. So we've hit this clean level of these bodies. Let's remove everything else. Remove, and remove. That's the 20-day level over here in black, right? We count back a bit more. We go 21, 22, 23, 24, 25, 26, 20, 30. So within the previous 60 data range, we have this rejection block which has not been touched yet. All right, over here, as you can see, it's not been traded to yet. We barely came close to it, and then we rallied. And here's a little observation. So 20-day high over here. All right, so relative to the 20-day look back period, the data range, we are in a premium. That's the first thing. Second of all, we have a pending, we have a liquidity pool that hasn't been traded to yet, which is down there, all right? This rejection block. So anyone who is long right now is hoping that this rejection block is going to hold price higher. They're hoping it's a safe way to put it's a safe place to place a stop loss. How do I know? Because that's how it works. And I would also, before being enlightened by these concepts, thanks to ICT, of course, all props to him. Go watch his YouTube channel, Core Content, and 2022 Mentorship. So that's one way I know, because it's just the way it is, and because it's observed in price action, and because me personally, before I knew these concepts, I would see a long wick and place my stop at the body. So I know it's how they think, it's how the crowds think, and the crowds are always wrong. All right, the crowds are never right. The majority loses. 95% of traders lose money. So, and before a side note on that stat, it's a true stat, and if anyone wants to come and refute it in the DMs, he will simply be blocked. Anyway, so this is the 60-day rejection block, which has not been traded to yet, right? So we've come shy of the 60-day liquidity pool, which is here. So this is what I'm thinking before I go and post the signal on Twitter, which is what I did. The trade idea, rather. Signal is not a word I would use at the moment. So the trade idea, before I posted on Twitter, I had this in mind. So relative to the 20-day range, we are in a premium. Relative to the, and we're attacking a clean level of these bodies. Look how equal they are. And we have a liquidity pool that hasn't been probed yet. And we have these two equal lows. Look at these clean bodies almost at the same level, right? So the idea was to accumulate the positions from here and unload them down here, right? At the bodies, of course, because when it comes to trading and actual trading, which barely anyone does, obviously, on Twitter, when it comes to actual trading, then a target where you expect a reversal is rejection blocks, right? So this was the framework I had in mind. Now let's dim these and focus on the candles themselves. We go to so we've seen the monthly, the weekly, and the daily. All right, that's step number 1. You check the monthly, you check the weekly, you check the daily. All right, and then you check the data ranges, and then you open, you decide, of course, in the data ranges, are we in a premium or discount? And then we open the weekly profile to find an entry. This is for short-term trading, all right? So these are my 5 steps. You can replay and listen to them again. ICTs are similar, which is seasonality, monthly bias, weekly profile, daily bias, time of day. But I skip seasonality because remove. So we now open the weekly profile with these in mind. We have this in mind, we have this in mind, we have this in mind. All right, so we have inner premium relative to the previous 20, 40, and 60 days. All right. And we're looking for a decline into the rejection block. Okay? Well, I was when I was giving this trade idea out. So 2 hour, which is the time frame I use personally for the weekly profiling. So we have this Sunday open to Friday close. Friday close is here. All right. So we have that level over here, and we are now breaching. We have now broken out. Now this is a common pattern in price action, is a fake, phony, false market structure shift right before a key level. So for example, there's no example better than live price action, but just for illustration purposes, let's assume here is a key level. All right. Got sick. This is a key level, this arrow. All right. This key level is it's not gonna be traded to directly like this, and it goes and repels. No, that would be too easy. Smart money is not that dumb. How's that for a play on words? So we go to we're usually, before hitting a key level, we're going to see some sort of consolidation. All right. Yep, like that. And then we see a false market structure shift, suckering in everyone. This is turtle soup, and then another turtle soup to sucker them in. So you sucker them out of their positions over here. You're suckering them into positions over here, and then one last dig deeper. So anyone who is trying to follow the trend is getting wrecked. And from there, that's the real reversal. And for those of you who remember the Enigma, it was satire, but it has some truth to it. There is truth in comedy. So this is what a key level approach is going to look like, ideally for me when I want to find an entry. All right. So it's not going to hit at once. It's going to go through a consolidation, turtle soup, fake market structure shift, and then a real violent, clear displacement lower, which is Judas, and then a displacement higher. All right. So this is what I was expecting to happen over here. So the key level is down here, which has not been traded to yet. It's not been probed yet. We're consolidating, turtle soup over here, which was tradable. very good trade, which I did not take. I'm not going to pretend like I'm some genius. I did try to enter on the way up here. I got a portion of that. But anyway, consolidation. Excuse me. Consolidation. Turtle soup. Market structure shift. Everyone's bullish. Everyone and their mama are buying up here. But look what happened. Weekly profile. Sunday gap. It opens with a gap to the upside. So instantly when that happens, I'm looking for a Judas. So opening price is here, right around here, 1.069 more or less. So when the Sunday price is opening to the upside, I'm expecting a Judas. Well, is it instant? Could be. Could it take a while? Like, could it really shoot up? Because sometimes you get a Judas where it opens and it shoots up non-stop, wrecking everyone who was long, wrecking everyone who was short, and not allowing new people to participate in the movement. Right? So here we have Judas to the upside. We have a consolidation during Monday and Tuesday. Now that's what you want to see because consolidations birth expansions, and expansions are followed by consolidations. Right? As I've mentioned many times on my Twitter. So I'm gonna have to end this pretty soon because I have something to do. Propulsion block right here. No, vacuum block for those who even remember what one is. They're not that common, or at least I don't use them that much. So vacuum block, turtle soup, fly, consolidation, and then on Tuesday during the Asian session, we had a manipulation. We had a move to the upside. So consolidation, accumulation, manipulation on Tuesday during the Asian session. So we can expect that to be followed by an expansion to the downside, and that is what I had in mind. All right, so my entry was right here. I'll be posting a picture of the execution after this video. But that was the thought process during the whole, during all this. All right. So to recap about the higher time frame PD raise and where we are relative to the higher time frame. Number one, 20-day premium. Number two, 60-day rejection block liquidity pool, which has not been probed yet, which we're expecting to be attacked. And number three, those equal highs, two equal lows. So we're accumulating from here, and we are distributing the same way smart money does, because we're emulating smart money. We're accumulating here and distributing down here. What's here? Go back in the video and you'll see. So sell here, and then we see a violent movement. Now when you see violent price movements like this, which are straight down or straight up, then that is usually a false move. All right. So although I would have liked it to continue down to 1.04800, which is the ultimate target for euro, if you see it trading down there, then don't be surprised. So although I would have liked to see it trade down here, but when I saw this violent decline in one straight line, that rhymes, a violent decline in one straight line into this low, and it didn't even close below it. It just stabbed right into it. All right. That's where I said, it might be time to abandon the ship right now. and clearly that was the correct decision. You got the attack, the turtle soup of the previous week's low, displacement, 4-hour FVG, which can be reasonably expected to hold as a buy, and you can target at least 50% of this of the price swing, because when you see this sharp price moves, then usually here's another one. These sharp price moves will usually be retraced at least by 50%, right? So that was the idea of the trade. Now, execution, which is more important. I gave out the trade over here. All right, I gave it out, I think, almost here. Let's remove everything and now focus on the 3 most important things to consider when you are executing a trade, which is the chart should have nothing. It should be naked of anything except 3 things: the entry, the stop loss, and the target. So this was what it looked like. The stop loss is going to be this intermediate term high, which I expect to hold at least until liquidity is taken out. I saw a bunch of you who follow me along closely also do the same thing. So good job, you. You know who you are. You go here, you go here. Stop loss here. All right. Target 1 is this previous week's low, which is also a market maker sell model lookalike. Accumulation, smart money reversal, and boom. And the other one was down here, of course, the other target. So TP1 was here, and target 2 was here. A partial, of course, at the low that purged the high. So that was the trade idea. And as I've said before, I'm thinking in probabilities. I don't care what price does. Why? Because simply I don't control price. I can read it pretty accurately, as you've seen for the past couple of months, but I don't care. It's all about risk to reward and percentage gain / loss. That's all that matters. So in this situation, premium 20-day, equal highs, liquidity pool that hasn't been probed yet down there, and the same pattern. Now look at the pattern where it comes in. The pattern comes in after all of that is said and done. Then the pattern comes in, and we can discuss the pattern, which is the key level. If you remember, I'm not drawing anything, but you can just imagine. Key level, consolidation, fake, real. Right? Let's just redraw it for completeness sake. So this is the pattern, and the pattern comes in after everything's considered. All right? Key level is this down here in bold. Now it's going to make the path bold too. For God's sake. Oh, great. Consolidation. And then a violent, either slightly in the key level or digs into the key level. So fake market structure shift, violent turtle soup / Judas / liquidity purge / spring, or whatever you want to call it. Yeah, you have to understand the idea. The naming doesn't matter. And then a real one, displacement. Now, when this one happens, no one believes it's real, but it's a real one. That's when you know when it's real. When you see someone on Twitter posting saying it's going to go down, guaranteed 100%. I've seen that happen a couple of times where, well, more than a couple of times where the real breakout finally occurs, and then some goofball comes and guarantees his audience that it's going to go back down. That's when I go all in. So, all that aside, the trade idea was this. I believe it was here. Plus minus some pips. It was like this. With with the arrow, right, and the eye. And it looks nice in now. The reason I entered over here, around here, was because of this, the possibility that it was going to turtle soup this one and just decline from Monday. So to be on the safe side, you're going to risk a small Judas here, or an extra layer, an extra degree of probing in the purge. But the stop loss is there. The invalidation of the idea is clear. All right. So that was the idea. Over here, stop loss here, target here, and a bunch of you liked it. You guys liked this trade, huh? And I must admit, it was flashy. It was a good one. So like this 1 to I believe it was 1 to 4 risk to it was 200 pips in one day. Called live on Twitter, if I may say so. And that's all there is for this video. The execution will be posted after this video directly. And I wish you all good luck and good trading. And see you in the next one. So, the idea was that NASDAQ was going to attack this range high after turtle souping the range low, right? So as we know, when you have a ranging market, then a purge of either side is going to take us to the other side, right? So the monthly, and of course, if you probe the order flow, then we are disrespecting this bullish order block, right? We close below it. We're supposed to accelerate downwards if it was a valid bearish order block, but it was invalidated. We did not respect the bearish PD array, and we created a bullish PD array, which is this breaker right here, right? And we have this bullish order block right here. So we trade above it, we come back into it, and we rally. So the monthly is bullish. The monthly is screaming bullish, and I've been saying it in the replies on Twitter, and I even gave out a trade idea a couple of weeks ago. It was I think it was 2 weeks ago. So we're expecting the month of, now I was expecting it to happen in April, but they did not give me that. So we're expecting a bullish expansion to the upside during the month of March. When you're expecting a bullish candle to print, then you look to buy below the open price, right? So bullish candle, you'll see right now. You wait for the open. If you're bullish, you wait for accumulation, manipulation into a discount PD array, and a rally, right? Which we'll see right now. So now down to the weekly. Of course, this is the infamous bar replay. However, this was called live on Twitter, right? I literally spoon-fed y'all a trade idea. So you can't complain. And if you do, then I can't help you. So let's probe. First of all, we have a range, right? Range low, range high. We purge the range low. So we have two targets, the 50% and the range high. So the eyes are up here. So the draw on liquidity price is gravitating towards the range high, right? Plus, it's disrespecting bullish PDRAs, bearish PDRAs, excuse me, on the monthly. It's disrespecting bearish PDRAs on the monthly, and respecting bullish PDRAs on the monthly. Now let's look at the weekly. The weekly is saying that, well, it's not talking, but the weekly chart is telling you that price is also, again, it's breaking highs, it's rejecting lows, right? It's breaking through bullish PDRAs, bearish, not bullish. It's breaking through this bearish order block, and it's respecting this bullish weekly FVG, right? So you got a turtle soup, and you got a rally. So monthly is bullish. Monthly is bullish. Weekly is bullish. So price is more likely to go upwards, and we have the range, of course. The range is saying, the range it's a cheat code. If you know what to look for, it can tell you a lot of stuff. So anyway, by all means, we are bullish, as we've said before, as I've said before, because there's no we here. I'm not your typical Twitter ICT influencer, quote unquote. This is a one-man show. So, how do you probe order flow? Highs and lows, order blocks, which is down close and up close candles. Are up close candles providing resistance or being broken through, and down close candles providing support, or vice versa? And FVGs. These are the three ways to measure and probe order flow, as you can see right now. So, lows and highs, we are rejecting the low, and we're breaking the high. That's one thing. Another thing is we are breaking through bearish PDRAs on the weekly, this one as well, and we're respecting bullish PDRAs, right? Which is the candles. So the up close candles are being broken through, and the down close candles are providing support. Gaps, same thing. So order flow is bullish on the weekly, and when you have weekly bullish order flow, then you can't expect resistance from a daily PDRA, right? Until the weekly objective is met, and so on. You can apply that to all time frames, as time and price are both fractal. What's going on over here? I'm drawing small dots. So, monthly order flow is bullish. Weekly, bullish. Now let's look at the daily. Got the daily here. And it was precisely over here that I called for the rally to the range high. Another key level is the monthly order block. All right? Let's draw a line on it. Order block, monthly, over here. I like to keep the charts clean, so let's just keep it a bit less dense. Is that the word? I don't think so. But anyway, we're not here to learn about photography or editing or whatever. Design, imagery. We are here to learn about price. So, we're breaking highs and we're rejecting lows, right? Highs broken, lows rejected, bullish candles providing bullish up close candles are being broken through, and down close candles are providing support. So order flow is bullish, right? Order flow is bullish. Highs, lows, bearish and bullish candles and gaps. By all means, order flow is bullish. So there is no reason to expect any downside. There is no reason to expect a turtle soup over here, which takes us down here to the range low, right? Why? Because we're respecting bullish PDRAs on the monthly and weekly and daily. So as long as the order flow is being respected, turtle soup follows order flow, right? You can't. They go hand in hand. If you try and trade turtle soup as a pattern, you'll get wrecked. You must understand order flow. So anyway, we were right here, right over here. So we broke through the high, and I mentioned this a lot of times. We broke through the high, so we're breaking highs. How do you know it broke through? Because you closed above the high. When we close above a high, and multiple times, right? Look at the difference between this close and this close. Not even a wick, right? So this is a rejection, and this is a break. And this is a rejection before a break. This is a common pattern which you'll recognize before a real breakout, right? There is a quick, sharp decline before a violent move upwards. Right? That's a little bit more advanced, more intricate. But for those who are interested in studying that, you can enjoy that little piece of that little nugget of information which I gave away. And yes, it is a nugget which you can use. How do you use that? Let's talk about that. How do you use that pattern or that little price fractal which repeats again and again and again before a real breakout, right? Of any range, there is a sharp false breakout first, and then a violent breakout, right? Same with the bearish. There is a before you break through the range, there is a violent retrace, and then it breaks out. All right. The purpose of this is to sucker in more sellers at this previous resistance level, right? And convince them of their positions. They add more and they get wrecked. Plus, that's one group of people getting fucked up. It also induces or entices, I don't like the word inducement, it's too cliche, everyone's using it. So it entices buyers above this high. They also get suckered in before being right. But the movement is so violent that they cower out again, right? That's group number 2, being screwed over. Group number 3, being screwed over, is the guy who was short down over here at this turtle soup. When it breaks above the high, then he gives away his position. In fear of it going and rallying higher. And it comes back down. He regrets. He sells again and he gets wrecked. Right? So there's always these 3 groups of people. Always in any price movement, there is these 3 groups of people, and usually they're the same person who's just trying to catch every single price swing and getting wrecked up and down. And this is something you will not understand unless you go and get wrecked yourself again and again and again and again. And you'll really understand each and every single price movement, why this happens, why that happens, why this happens. That's on a personal level, but on a smart money versus dumb money level, that's the explanation of what's the purpose of this move? Because every single price move, as I say, every single price move has an explanation, right? So, well, it's nonsense. Of course, you use it how? Because over here, before we remove it, how do you use this? Well, you can use it by being long from the range low anyway, right? That's the cleanest. Those are my moves. I enter at the extremities of the range, or the 50%, or a higher time frame PD array. However, a model that has been showed to you is the turtle soup at the 50% of the range. And that is where this comes in play. Before the breakout, there's a turtle soup that happens at or near the 50% of the range. If that resonates with you, you can use it as a model. Because as I mentioned before many times, you want to find one model which you perfect, not try everything out, right? You want to go and marry one girl, one woman, and create a nice long lasting, sustainable relationship, which means something, right? You got a house together, you got kids, you got a whole life together. Yeah? You got memories, you have going through adversity together, right? You have all of this with one person, as opposed to one night stand here, one night stand here, one here, one here, one here, meaningless. This is a good comparison, an analogy of having a model versus having no model, right? I'm not sure how it went over there, but that is an analogy. So we remove all of this nonsense and we focus on the trade idea. We broke through the high and we created a PD array at the high, which is this FVG, right? Right over here. And that is when I said, folks, my friends, ladies and gentlemen, we're going to attack this August high from here. The trade idea I gave out was this. So we trade back into the high, and this is where the SR flips work, but they don't work because they're SR flips. They work because of the PD array created at the high, which is this order block FVG, right? Order block FVG combination. So the idea I gave out was this, was we trade back into the FVG, into the broken high, and we rally off to the races to August high. Obviously, potentially a bit higher, because a liquidity purge is going to be it's not going to be to the tick and then it's going to decline. No, it's going to be a bit higher. It varies according to the time frame, but that's the point. And you don't know if it's going to be a break or purge. You have to watch. You have some indications, which I'm not going to speak about over here because there's not much time. But generally speaking, you want to anticipate a run slightly above the high or below the low, right? So the anticipation was, in summary, because I know some people like to hear the rants and others just want to get to the point. So in summary, we break the high, we create the PD array at the high, As soon as this happens, we have displacement, we have a break of the high, we have bullish order flow on the monthly, weekly, and daily. So we expect to retrace into the FVG and a rally. And what happened? That is precisely what happened. Now, right over here, when you see this dump, which happened right over here, right here. Now, how many of you would get suckered into selling that? Probably more than I would like to say so. However, the rule says if we're breaking highs, then the dump below the low is a fake turtle soup. Plus, it's into a PD array. Right? Also on the weekly time frame, which is I'm going to leave to you. So when we're bullish, then bearish dumps are to be bought. Right? That is when you buy the dip. You don't buy the dip in a downtrending market. You buy the dip in an uptrending market. Right? On the right side of the curve. So we decline into the FVG. We give it a second touch, and this is where I call for ES to rally. That's also another review, which is going to come out soon this week. Hopefully. Inshallah. So, the dump below the low is expected to be a fake, false, phony turtle soup, and we rally. And that is precisely what happened, right? Just blast it off. And the stop loss was also given. So this was pretty much a spoon-fed idea, which I used to do a lot back in the day. I do less of it now, but I still do it. Just not as much. But here was one. The stop loss could have been this, all right? But I'm a dickhead, so I give conservative stop losses on Twitter, which is this intermediate term low, right? And that was the trade idea, which you see. I will either have posted the picture before this video or after this video. And that is it, my friends. A short, quick, I'm not exactly sure how long this video was, but that is a short, quick analysis of the Nasdaq trade, price-wise. Time-wise, if you look at the open, high, low, and close of the monthly chart, why is this not giving me the... All right. Well, if you look at the open, high, low, and close of the monthly chart, exit, yes. Let's go to the monthly candle. And yes, it's delayed data for the dickheads because I don't trade NASDAQ. I trade NAS 100. If I do trade NASDAQ or ES. I don't trade ES, at least now. I trade SPX 500 if I do, right? So I don't need to buy this. You can buy it. You can go and do what you want. There were some goofballs commenting on the delayed data, right? It's always funny because people always find something to bitch about. Generally speaking, I don't mind. I like to just have a back and forth, a playful back and forth, as long as it's respectful. If you're disrespectful, then I probably won't engage with you, right? If you're having a playful, fun back and forth, then sure, I'm game. So, the monthly candles power of 3. So we're bullish. What did I say? We expect to buy below the open price, right? There's so much more. But let's stay on topic. Let us stay on topic. So let's go back to the beginning of the month, right? Let's go to the daily right now. Why is this time messed up? What is this? Let's open a NASDAQ chart for this one. Let's open a NAS 100. NAS 100. Cleaner. Let's go to the monthly. Remove this. So my expectation was a classic buy candle. Literally an expansion to the upside. Why? I will leave that for you to figure out. Good luck with it. I've mentioned it on my Twitter a couple times. So if you haven't had the focus to go and dig deep, then you don't deserve to know. Oh, but I don't have time. I'm busy with life. You don't deserve to know. Because if you really wanted to know, you would dig deep and you would know. Oh, but I got kids. I got fam. You don't deserve to know. So, monthly. Let's go to the... Remove this. So, too many so's, but I just woke up, so who cares? So the monthly candle opens, as we said, when we're bullish, right? I like to see the monthly in the 4 hour. Gives me a nice view. When we are bullish and we're expecting higher prices, then what do? Then we simply buy below the opening price. We wait for a manipulation below the open price and we buy, right? Before the month opens, we have the two key levels which we expect to cap the monthly candle, right? Or the expansion, whatever candle it is. Before the candle opens and you're expecting an expansion candle, then you draw the two key levels which you expect to provide the expansion from the low to the high. So we have here 4 hour. All right, let's pretend this never happened. Right here, none of this happened. We have these two key levels right over here. We have this one, the August high, and the monthly order block up here. But as always, when you have a target, when you're in a trade, then it's always good to exit at 75% of the target. That's what I do. So the monthly candle opens. We decline below the opening price, right? So manipulation. As soon as you see a decline, obviously not blindly within context, but when you see a decline or a rally below or above the opening price, then you should be on alert. You got this. You got a beautiful, beautiful open. When we're bullish, we buy below the opening price. Right, so you buy here. Your stop loss is going to be either down here or you choose an intermediate term low nearby. And then you ride until price reaches the opposite end of the range you're expecting it to go, right? It's open. You buy below the opening price and you wait for your trade to play out. Now, I was going to use the RR tool, but that's too tacky. You get the idea. All right, so entry would be this. So again, open, decline, key level, higher time frame, daily order block is giving you a 4 hour expansion, right? while we're bullish on the monthly and we're expecting a monthly bullish candle. So that was the idea. As soon as it hits this top, or even before you're out of the trade idea, as a tape reading practice, you can wait. You can watch it. You can always watch it. That's another thing, is when you miss a move, don't be pissed. When you miss your entry and you don't get a fill, for example, that's an opportunity for you to learn, right? So you should be happy when you lose. You should be happy when you miss opportunities, because that is a way for you to learn about price. Open, decline, expansion, right? And again, before the break, a fake decline, and then a true break, right? Anyway, that is the NASDAQ described from both lenses of time and price. And that is pretty much it, my friends. And a quick bonus for those of you who stuck it out till here. There was a trade over here, a trade idea which had formed potentially, but failed. Let's look at why it failed. Right over here. The idea was breaker into these equal lows, right? Looks reasonable. Breaker into the equal lows, right? However, you could argue that it's a valid idea, right? It's not completely invalid, because it was a low that did not purge. It was a mere stop hunt of the high. Breaker into equal lows. That's a valid setup. However, which I did give out, by the way. Now, when you see price approaching a breaker, then what do you want to see? You want to see it wicking through the body and never closing above the closing price of the breaker, right? So what you don't want to see is this closing side. That is a horrible sign, and that is usually a sign that it's going to target the breaker's high, right? So when you have a bearish bias and you see a breaker being disrespected, then you can reasonably anticipate that the breaker's high is going to be purged, right? Or attacked or targeted. So that in itself is a trade idea. So you go and you find a lower time frame PD array inside of that breaker, right? So it's sort of an inverted breaker. See the beauty? Breaker disrespected and flipped into support. Target is breaker's high. Right? That is a key aspect of watching breakers when you trade them. And you'll notice this by yourself, is you never want to see them close above the closing price of the breaker. Right? You want to see them wick through. Let's see if you can find a breaker nearby. A valid, correct breaker. There should be one nearby. Not too far away. Furthermore, it is a smaller time frame, so it should be pretty quick. Let's say this one, for example. Right? high, low, higher high. We close below this candle, this specific candle, right? Now, this is where controversy comes in breaker selection, right? Some people like to choose the two candles together. Some people like to pinpoint the exact candle that caused the purge, right? To be safe, you can do this, right? I mean, the risk reward is still pretty good. But to be precise, there's always a specific candle responsible, right? But for the sake of this recording, let's say it's these two candles together, right? Look at the close of the breaker and look at the respect price has for the close. Right? So as with the other PD arrays, wick, and fast decline. As with the other PD arrays, the invalidation of a PD array starts from a close above the mean threshold of the PD array, right? The 50%. So that's a way to cut half of the stop loss, right? That's the purpose of knowing that. It's not just for the sake of it. It's not just for the sake of knowing it. So that's a quick breaker explanation. And let's find another example of a valid breaker for the sakeness of completion. It shouldn't take too long. Let's use a normal one first, which is right here, right? You got a high, you got a low, you got a higher high, and you break through it. This is your breaker. This entire candle is your breaker. Now, this is why the signs of the failure of a breaker are as follows. Number one, a close above the close, right? But these weren't so convincing, right? It's closing, but it's never closing twice, for example, right? It's never closing twice. Here, close once. It's going deep, huh? 1, 2. One, a weak double close, and then it closes back below. Only one strong one, and then a second one below, right? Also respecting the 50%, right? So the number of closes is also an important factor of determining a real versus a fake break, whether it's a breakout, whether it's an invalidation of a PD array. That is something I leave for your studies. Same over here. How many closes did it close? Just one, right? One close below, one above, and so on. So, same over here. Just one over here. And the second one was below and decline. Also, this did not disrespect this bearish PD array. The 50% of the PD array was respected, measuring the body, of course. All right? So the number of closes matter. The number of closes matter. And let's find another breaker. Here's some breaker drill. This one right here. You got a low, you got a high, you got a lower low, and you got a green or an up-close candle that caused the purge. This is how the ideal breaker looks like, right? A thick, high-volume, bulky candle which preceded the violent move downwards. Turtle soup, rally. As soon as you close twice above the breaker, 1, 2, right, and then it consolidates. So we've closed, we've unlocked. That's how we think about it. We've unlocked the breaker, right? And then we also created a PD array at this high, which is FVG. FVG plus breaker plus breaking through this high plus rejecting this low, right? So we're breaking through bullish candles. We're getting support from bearish candles, right? Right here, support, breaking through the bullish candles, rejecting lows, and breaking highs. So order flow, by all means, is bullish right here. You get this nice breaker, which happens to be happening after a purge of the range low, range high. So the target is the range high anyway, right? You got that. Entry, stop loss, target, and so on. So that's pretty much all there is to this video. It took way too long. It took way too long, but it is what it is. The main focus was on the NAS trade idea, right? Which was, let's take a last summary. Go over here. Delete, remove all drawings, and that's a forbidden word. So we're here. Good old bar replay, because it's all hindsight, right? It's all hindsight. Over here. August high. We are breaking the high. Order flow is bullish on the monthly. We're bullish on the weekly. We are also bullish, right? On the daily, we are breaking the high, retracing into an FVG after spending a considerable amount of time. Now, do you know how much time that was, which we spent over here before actually flying? The amount of time we spent before providing the real move was after the break, of course, right? Around 20 days. So this is a prime turtle soup example. Just beautiful. Right? You could have been suckered in by this one. But if you had your stop loss down here, you'd be fine. Or you could have waited for the month. You could have waited for the next month to enter, right, up here, after the turtle soup forms itself, because you can use turtle soup either as an entry or as a confirmation for your buys. So it's never a bad idea to understand turtle soup, because it happens all the time. All the time. Turtle soup. With an SMT, of course. So failure swing. Turtle soup the bodies. You got a turtle soup here. You get a turtle soup all the time. There's always a turtle soup somewhere happening at a higher time frame PD array, right? False breakdown. False breakdown. You get the idea, right? So it's never bad to understand turtle soup. Never. Either to use it as an entry or as a confirmation for your bias. So the 20, 40, 60-day look back, we are purging a 20-day low, right? So it's very unlikely that we keep rallying just like that, right? Because price is always moving in trend, range, trend, range, trend, range, and so on. So the idea was, for the last final time, I haven't done a video for so long that I just keep ranting and ranting and talking and talking, but deal with it. That's what you get. You get this. The expectation is to decline into the FVG, the PD array created at the high, and then a violent rally. Stop loss over here, or here, because this is a turtle soup low, right? Which holds a lot of trapped liquidity down here. Plus these two consecutive down candles. So it would be a reasonable stop loss to keep it up here. If you kept your stop loss here, I wouldn't blame you. Over here is simply safer, but here's also a good one. Here was a good stop loss with a higher risk to reward. So you get that, you get a decline, and you get a violent rally far away. And she never stopped. Is it a she? Is it a he? Are they gender neutral? I don't know. But no one cares. So, that's all for now. I hope you found that insightful. And good luck and good trading and a happy Sunday for those who are watching today.